left off. Right, so colleagues, welcome to video B of our lecture 3 in AUE 3761 engagement. So I was explaining earlier concerning section 38, which deals with the registration of firms as registered auditors. So there are different ways, obviously, by which audit firms can be established. So it can be established in form of partnership where different registered auditors come together as individuals and then they formulate a partnership as an entity in form of a registered audit firm to operate, or it can be in form of an individual that is a registered auditor that decide to register in form as a sole proprietor. There's also that option. Then, of course, but majority of which is common for most of these audit firms out there, they're in form of companies, and also majority they are also in form of partnership. They are mostly in form of partnership, or it can be in form of a company, depending on the size, right? So, but if it's a company now, it means they have to follow standardized procedures of how a company is incorporated. So that implies they would have to have an MOI in place, which is a memorandum of incorporation, setting out the details of who is responsible for what, who are the owners of that organization, who are the directors, and all that. So that information and the prescribed officers, right, of the organization, and for what period would those prescribed officers be, inducted to perform certain responsibilities in the company. So we're talking about in the prescribed officers here. These are the CEOs, the chief financial officer of the firm, and likes. So all of that information should be clearly defined in the MOI of the company. So, like any other organization, individuals who are shareholders, right, they have to have some form of membership, right? They need to have some form of membership. That is in the case where the company is actually a private company. Because audit firms, you've got small firms, small, medium firms, and then you've got those ones which are big, like your big five, your PwCs, your KPMGs, and all that. Now, those ones are big firms, so they are like public entities in the sense of size. Right? So obviously, if it is a smaller one, it needs to only have individuals who are registered as auditors to become shareholders. And for every shareholder, there must be a director, and every director must be a shareholder. So normally, under normal circumstances, audit firms, if you're an audit partner, under normal circumstances, you also be considered to be one of the directors in that firm. So these are just some procedures that you need to be aware of. But this information was introduced to you at second year level. So I will not be touching so much into detail on this because it will be more like repetition and all that. But I have notes from second year that I can also give to you guys to use, right? Okay, so that was section 38 of your APA Act. Just in summary, section 41 deals with the conduct and liability of registered auditors. Now I'm pointing out things that they will definitely ask you, right? Conduct and liability of registered auditors. So if you go to your audit notes, there is section 41 of the APA Act. What does it deal with? What does it deal with? It deals with conduct by and liability of registered auditors. So what is the practice approved? So only registered auditors may engage in a public practice. So what about if you're not a registered auditor? You cannot be engaging in public practice. What is public practice? Public practice now means you being hired as an external auditor, come and audit a particular organization. So if you're not registered as a registered auditor, you are not capacitated. You're not allowed in terms of the APA Act to perform responsibilities to the client unless you have the designation of a registered auditor. Now, what about a person who is not a registered auditor in terms of the APA Act? Here are the things that they are not allowed to do. So if you're not registered as a registered auditor, you're not allowed to perform any audits. You're not allowed to pretend to be or to hold out to be registered in terms of the APA Act. So this is not allowed. You're not allowed to use the name of any registered auditor. Neither are you allowed to perform any act to lead persons to believe that you are a registered auditor in terms of the APA Act. So these are certain conducts that are not allowed in terms of the APA Act. Very important. Notice this is dealing with auditors. So if you're not registered as a registered auditor according to the APA Act, these are the things that you're not allowed to do. So it's only conduct that is allowed to be conducted or performed by someone who is actually a registered auditor. Very, very important. So that's what you draw from section 41. Some of those notes and stuff is just to emphasize more on what they've already pointed out. Right. Now, what about those which registered auditors are not allowed to do? This is where the liabilities, all right, this is where the liability of a registered auditor emanates from. So if you are a registered auditor, there are certain things you are not allowed to do. Mind you, still in the very same section, we notice there are certain things, that registered auditors are not allowed to do. Just a second, guys. Right. So what I want you to draw from this section 41 is the conduct that is not allowed of people that are not registered as auditors according to the APA Act, all of them. And then there are those conducts which are registered auditors okay, that registered auditors themselves, they are not allowed to do. Number one, practice under a firm name unless every letterhead bears the firm name, the first name and all of that. Okay, sign any account, statement, report, or other document which purports to represent an audit unless the audit was performed. So they're not supposed to just, find themselves signing documents to say, no, yeah, we've already conducted the audit, whereas they've not performed the audit. If they do that, it means there is no due diligence that has been exercised. We are not allowed as registered auditors to perform audits unless adequate risk management practices and procedures are in place. We are not allowed to engage in public practice if we have been suspended, supposedly, from, performing certain responsibilities. As auditors, we are not allowed to share any profit derived from performing an audit with a person that is not a registered auditor. Very important. So what are you going to be looking for in the context of a test? You're going to be looking for scenarios where maybe, for instance, you are told that a registered auditor, shared the profit that was made by the firm by somebody who is not a partner in the audit firm. Now, if you have such a case like that, it means there is misconduct on the side of the registered auditor that is liable for that. So now that would be a non-conformity to the APA Act in terms of section 41, but you don't have to quote the section numbers like I said earlier, right? So that was section 41 of the APA Act. Section 44 now deals with duties in relation to an audit. What is it that we are expected to do when we are conducting an audit? So if you go again to audit notes, it gives you the duties in relation to an audit. Very important. These things, you need to know them. What is it that we are allowed to do during a course of an audit as auditors, right? So if you are appointed to perform an audit, all right, very important, it's important for the firm, the audit firm, right, to know which individuals within the firm would be assigned to conduct the audit. Remember, as an audit firm, what is happening? You are a team of different registered auditors. You might be a team of 10 registered auditors. So you find maybe in a quarter of a year, first quarter, for instance, you get about 5 audits. Now, you can't all of you work on one audit per se. You need to allocate yourselves to, to different audits. So it's very important that whenever you get an audit, you allocate your team accordingly based on the available resources. It's one of the things I'll teach you in then Unit 2 to say, what do you do during what we call a pre-engagement audit activities? That is before you even approve the audit client. what are the things that you do to assess, evaluate, you know, whether to accept an audit audit client or not. So what are the things that you need to do prior to accepting an audit client? So yeah, it's one of the things I'll deal with in learning unit number 2. It's very important. They love testing you guys on that quite often. Now, but anyways, so talking about the duties in relation to an audit, this is what we as auditors are expected to do. But this is in the context of a firm. So the registered firm needs to allocate certain individuals who are registered auditors to perform the responsibilities to specific audit assignments that have been assigned to the firm. So if there are 5, then obviously we might need to have 2 different auditors assigned to each of their respective 5 audit assignments laid on the table. Now, once we've assigned them, what should happen next? Notice here, registered auditors may not express an opinion without qualification that the financial statements are fairly presented in all material respects, are properly prepared in all material respects in accordance with the basis of the IFRS standards. Okay, so what are they saying there? Because we need to break down this information to make it more simplified and meaningful. So they're simply saying that you cannot give out an audit opinion over financial statements unless you have clear grounds, unless you have conducted and gathered evidence. So let me put it down in footnote for me so that it makes sense. So they are simply saying that a registered auditor, or abbreviate, right, should not issue an audit opinion without sufficient and appropriate audit evidence in place. That's what they are saying there. You as a registered auditors, you may not and you should not express an audit opinion unless you have got sufficient and appropriate audit evidence in place. To do what? Sufficient and appropriate audit evidence to substantiate that the financial statements that you have audited, they are fairly presented in all material respects, the financial position of the entity and the results of its operations and cash flow, and that they are properly prepared according to the IFRS standards. So the evidence you've gathered, it will be the one that will be sufficient enough and relevant to the case to get to a point where you can conclude whether these financial statements are fairly presented, and of course, whether they are aligning to the IFRS standards. Unless, remember, unless if the audit has been carried out free of restriction. So the only time an audit opinion is expressed, that is if an audit has been carried out free of restriction in compliance with applicable audit pronouncements. The registered auditor has satisfied himself of the existence of all assets, liabilities shown in the financial statements. What is that? It means that you have evidence to prove that the assets are existing. You've got evidence to prove that the liabilities that the organization have in truthfulness is actually existing. They are owing certain third parties X amount of money. You see, unless otherwise there's proper accounting records that have been kept at least in one of the official languages, or the information, vouchers, documents, which the registered auditor's opinion was expressed when necessary for the proper performance of the auditor's duty have been obtained. What are we saying there? Do you see that all of these things, of course, it's a breakdown of what I've already given you here, to say that a registered auditor should not issue an audit opinion unless there is what? Sufficient and appropriate evidence. And that sufficient and appropriate evidence is sufficient and appropriate evidence on what basis? On the basis that there is what? The audit has been carried out free of restrictions. There is compliance to the audit pronouncements, which is, the APA Act and other legislative documents. In summary, so essentially, these are the duties of the auditors. So the only time you issue an audit opinion, that is if this has been complied with. Unless this has been complied with. That's the only time when an audit opinion is expressed. So you don't express an audit opinion over financial statements unless you've gathered evidence to prove that indeed the financial statements that have been prepared by the client indeed are prepared in accordance to the IFRS standards, and they've been fairly presented, reflecting on the company's financial position as well as the financial performance and the cash flows, right? Very, very important. I'm just trying to, to bring these things into more meaningful information for you and simplified in a way, right? Are we together, leader?
Yeah, we're together.
Perfect. The duty to report on irregularities. So we also have duties as auditors to report on irregularities. So RI here, abbreviated, stands for reportable irregularities. Now, what is an irregularity? Because you cannot report on something that you don't understand. If we're saying that there's a reportable irregularity, okay, what is it that defines an irregularity? So the most important thing to draw out of this section number 45 is, what is a reportable irregularity? So according to the definition in section 1 of the Act, it stipulates here that a reportable irregularity can be any unlawful or omission committed by any person responsible for management of an entity which has caused or is likely to cause financial loss to the entity or to its partner, member, shareholder, creditor, or investor, or a reportable irregularity here could also mean that maybe there's fraudulent amounts or theft that has taken place. Who would have perpetrated it? Obviously, it's management. And also a reportable irregularity could mean, a case whereby there's a material breach of any financial duty owed by such a person to the entity or a partner. So if there's a breach of contract, for instance, that's a reportable irregularity. Notice all of these things, they are reportable irregularities, which we as auditors, when we are auditing, we are also looking to see if these things are existing as far as the financial records of the organizations is concerned. Remember, it's not just only financial statements of interest that we are having, because whatever we see in the financial statements, it comes from somewhere. I mean, looking at the accounting process, let me take you somewhere briefly. Looking at the accounting process, it starts from, I want to take you to the whiteboard quickly so that I can emphasize some details here. You see, with the accounting process, guys, it operates like this, so that you understand the auditing of financial statements, that it's not just limited to what you see in the financials of the organization, financial reports, right? So now it operates like this. Let's use blue, right? Okay, so it starts with source documents. Then we enter the information in the journals. From the journals, we compile the general ledger. From the general ledger, we need to have summary of accounts in form of a trial balance. And then we need to have financial statements, which is, of course, the information of interest to us as registered auditors. But we don't limit this without, we don't just only look at financial statements, but we also look at the notes to the annual financial statements, because there will be such information also that accompanies the financial statements themselves. So notice here what is happening. From the point where you start with source documents, let me put it this way. From the source documents all the way to the journals, what is happening there? What information are we recording? We are simply recording transactions. So it's possible that as we are reviewing some records that are captured in the journals, remember, journals can be anything like cash payment journal, cash receipts journal, sales journal, purchases journal, and all of that, general journals and all that. So what do we see when we go to those records? We are seeing records of transactions. But these records of transactions have to have some source document supporting it. So what are those source documents? This is anything like your credit notes, your invoices, your debit notes, your receipts, your bank statements is part of it, and all of that. So journals, obviously, like I mentioned here, it can be anything like a CPJ or cash book, cash receipts journal, sales journal, purchases journal, and all of that. So what do we see here? We're simply seeing transactions where in the records in form of journals, right? And then, of course, here, these are the source documents supporting the records that are in the journal. What happens now if I look at the records in the journals and I'm seeing that there's no supporting document attached to that transaction? It means there's something, there's an irregularity there. Something is wrong. Does it make sense?
Yeah.
Yeah, it means something is off. So when I pick up something of that nature, should I keep quiet about it as an auditor? The answer is no, I have to report it. So those are reportable irregularities. Why is it that we have to report such info? Maybe say an irregularity pertaining to transactions, because it will affect what will be captured here in your GL. It will affect the balance in the trial balance, which is basically a summary of what has already been balanced from the GL. It will also affect whatever that will be reflected in the financial statements. It means we could either have overstatements because we have recorded something that is non-existing here. Why? Because there's no supporting document. So we could either have overstatements taking place now in our account balances. So what you're dealing with from here all the way to your financial statements, okay? What is happening really? These are account balances. So these are account balances. But what we have from source documents to subsidiary journals, these are transactions. That's where the difference is. And that's where the concept of accessions is derived. So there's accessions only relative to transactions and records, as they would call it. And then you also have accessions only directed to account. I don't know why it's now doing like that. Only directed or aimed to account balances. So we've got accessions only aimed at what? Account balances. So it's also possible that we can have a balance here in the GL of inventory. Let's just assume this is the inventory balance, inventory account in the GL. The balance is saying 50,000. But when you go to the financial statement, to be more precise, in the statement of financial position, when I look at the inventory account balance recorded there, it's saying the inventory amount is 70K, 70,000. Now, if I compare the two, do you see that they are not corresponding?
Yes.
So that means something went wrong here. There's an irregularity in terms of recording of balances here. And that is part and parcel of those things that we need to report on, which is exactly what they're explaining to you here. Unlawful acts, omissions. So maybe the balance we are having over here, maybe say it's a transaction that we have captured here. Maybe it was just an omission because by the time when we received the bank statement, we only have X amount of transactions. So now that automatically affect whatever records we captured here. So there can be omissions in terms of transactions that are recorded here. Why? Maybe it could be timing difference, you see. But in this case, where you have got inventory balance of 50,000 in the general ledger, and then inventory balance of 70K in the statement of financial position, that's an overstatement. So what they're trying to say is that they've got more closing inventory than what they actually have in stock when you go to the warehouse. So when I look at this, it means there's an overstatement of the inventory account balance. And when I pick up something like that, that's a reportable irregularity. Because now we need to find out, why is there a difference of 20,000 between the two? What was management trying to achieve? Is it an error or was it an intentional mistake? So there's a difference between an error. An error, it can happen as a result of human error, but then if it's intentional, it's no longer an error now. It means that's an irregularity. So that's where things like fraud take place. It could be as a result of fraudulent activity that is taking place. Management is trying to cover up their tracks. So they can have fraudulent account balances being reflected in the financial statements. Why? Because they're trying to portray a certain reflection about the company, which is not true. They do that normally if they want to obtain loans, for example, or I mean from creditors, obviously, or they do that sometimes if they want to be paid bonuses. So they would reflect a certain picture as if the company has been doing very well, whereas in actual fact, the company is actually making losses. So all of those things, when we come to audit, when we identify such, those are reportable irregularities we ought to report about as auditors when we are conducting our duties and our responsibility. Very important. Very important. Woohoo. Is it making sense?
Yeah, definitely.
Lovely. So I was just trying to emphasize to make sure that at least it's clear. Then if you go to section 46, let me go to section 46. Deals with the limitation of the auditor's liability. So what they are, in as far as our responsibilities are concerned, there are certain things we can do, but there are certain things we cannot do. So that's the limitation of our liability. So now let's have a look at that. All right, so here they are still continuing really exploring further on section 45, but I'm not going to do that because it's really the same things I was explaining earlier, even with illustrations on the whiteboard. So I'm going to quickly go straight to section 46. Yeah, so the issue about reportable irregularities, it's a very broad one, but let me try to jump to section 46. So section 46 deals with the limitation of liability, right? So this of course relates to liability of the registered auditor in respect of an audit conducted in accordance with the ISAS of financial statements. So these are international standards of auditing of financial statements, right? So we call them the ISA standards, basically. So the S there stands for standards. So ISA standards of financial statements. So that's where you have your ISA 200, your ISA 300, and all of that, right? With the objective of expressing an opinion as to their fairness in relation to the identified financial reporting. So now, the auditor, according to section 46, shall, in respect of any opinion expressed or report, a statement made, incur no liability to a client or third party. So in other words, there should be no monies that will be owed to third party because of what is being done in the audit process, unless it is proved that such opinion or report statement was made maliciously or fraudulently or pursuant to a negligent performance of the auditor's duty. So if we have such, then it means there's a problem. We'll be infringing our responsibilities when we do that. Nothing much really on the section 46. Section 52, which is what I would like to end with, reportable irregularities and false statements in connection with audit. So there are implications if we issue, so if we don't report reportable irregularities and we issue false statements. Let's say, for example, you pick up that, okay, the are misstatements, like for instance, the inventory was overstated for some reason, right? In the statement of financial position, why maybe they're trying to increase or to look like as if their liquidity is good. Remember, inventory, it's part and parcel of what? Current assets. So obviously, if you've got more current assets than current liabilities, it means your liquidity is good. And that increases your chances of getting credit from creditors or from lenders out there, right? So, and we as auditors, when we come into audit and we pick up, no. What is being reflected as the liquidity of this organization is actually false, right? And then for some reason, we find ourselves in a dilemma where we accept to be given a gift so that we issue an unqualified audit opinion. An unqualified audit opinion simply means it's an audit opinion that is simply to say everything that has been presented in the financial statements is truly giving the true picture of how the company is performed. That's an unqualified audit opinion. So it means the company is, has reported exactly what is happening. But if we see a qualified audit opinion, it means whatever they've actually presented there are irregularities that we have picked up. That's a qualified audit opinion. Now, in section 52, which is dealing with reportable irregularities, this is now where you find scenarios where an auditor, even though they know that the financials that the organization has presented is not the true reflection of what is happening in the organization, and then they issue a qualified audit opinion. Now, what does the APA Act, stipulates with regards to circumstances like that? That's what you deal with in section 52. Right. So let's quickly get a brief on that, because I had wanted to also go through the Companies Act, but I'm thinking maybe for the interest of time, it might not really work. But anyways, let's try to see how far we can cover, because I can try to combine maybe the Companies Act and the other stuff on when I'm dealing with part 3, right? I'll combine it with the King 4 report. Now look at section 52, reportable irregularities, false statements in connection with audit. So the only section in chapter 4 states that a registered auditor who fails to report a reportable irregularity, or knowingly or recklessly express an opinion or makes a report or other statement which is false in a material respect shall be guilty of an offense. Do you say it now? So what I was explaining to you earlier, to say they know the true reflection of what is happening in the company, it's actually bad. But the company has portrayed that, look, we are doing well. Their liquidity is positive. And we as auditors, we can clearly see, no. The liquidity is very poor. And then we say, no, we issue a qualified opinion to say, no, everything that they've reported is actually fairly presented. Now, when we do that, we will be guilty of an offense. That's what section 52 is telling you. So hence I was explaining it to you in summary earlier, just so that even when I get to the content or the details of the section itself, you can make sense of what is happening there. Are we together, sir?
Yes, we're together.
Beautiful. Right. So a registered auditor, so what happens now is it can go, the offense can go as far as even leading to court cases, because obviously, I mean, if you issue, a false statement about financial statements of an organization, it means you will be misleading investors on the decision they can make, on the informed decision that they could have made over that particular organization you're auditing. So say if the company is performing poorly, right, and you tell the auditors, the shareholders that, look, the company is doing very well according to our opinion as auditors, this company is doing very well. So what do you think the shareholders would do? They will invest more money into that company. But whereas the company is actually going down, probably it's going to be sequestrated 3 months down the line. So imagine they're pumping more money. That's going to cost them their share portfolio. And they will not let that go or just slide just like that without holding you as the auditors accountable for misleading them through the false statement. So hence we see in note number A here, a registered auditor convicted in a court of law under this section is liable to fine and possible imprisonment of up to 10 years. That's serious. See, because if you issue a misleading statement or an audit opinion to shareholders, they will make wrong decisions which can cost them millions. Same thing with creditors. If creditors, if you tell them, look, the financial statement of this company is actually good, they've got liquidity, they are meeting their going concern assumption, guess what would the creditors do? The creditors would say, no, look, we can sell more goods to you guys on credit, or we can give you loans as an organization. But then only to find out that the organization they're giving loans to, the organization they're selling certain goods on credit to, they are not eligible to pay them. So guess what happens now? That's financial losses to the creditors. That's excessive losses to the lenders of finance to such organizations. So guess what? because of the detrimental effect that misleading statements have on the users of financial statements. There are serious consequences if, you know, we as auditors don't issue the right or the, you know, the correct opinion as far as the financial statements in question is concerned. So for a criminal conviction to be obtained against a registered auditor for failing to report a reportable irregularity, he must have intentionally or deliberately not reported it. Exactly what I was telling you. So what can lead to the auditor intentionally or deliberately not reporting? It's either there was a gift of material significance in terms of money that he was promised maybe by management to say, look, if you don't report about this, we're going to give you R1 million. In practice, those things are happening, you know. It's just that maybe some of those things you may never find out about them on the news. But I mean, those kind of things, they do happen. I wouldn't want to mention names of some firms which are big actually that had scandals like that. See. But in reality, such things do happen. So that was to summarize your APA Act sections. So what we would do in the next lecture session, which is not going to be today, but over the weekend on Sunday possibly, we will be proceeding to the Companies Act and as well as to the King 4 report, part 3 of this learning unit. And we'll be concluding this whole learning unit 1 in this week. Thank you so much, sir, for your time.
No, thank you for the lecture. It's been very helpful. Thank you.
You're welcome, sir. Cheers.
Take care. Bye-bye.
All right.